In 2014, the Bank of England published a paper that should have been front-page news around the world. It was titled Money Creation in the Modern Economy. And it said something that many people do not want to believe. Commercial banks create money. They do not store it. They do not redistribute it. They create it. Out of thin air. Every time a bank approves a loan, a mortgage, a car loan, a line of credit for a business, it does not look for the money in a vault. It does not take it from other clients' deposits. It types it. Literally. It adds a number to the borrower's account. And that number is new money that did not exist a second before. It sounds like science fiction. It sounds like a scam. But it is the official mechanism, recognized by every central bank in the world, that explains how most of the money you use every day works. Around 97% of the money in circulation in a modern economy was not created by the government or the central bank. It was created by commercial banks. Your bank. The bank on the corner. Let us see how. In the previous episode, we saw how the London goldsmiths discovered fractional reserve. They lent the gold deposited by their clients, keeping only a fraction in reserve. As long as nobody claimed everything at once, the trick worked. Today we go a step further. Because fractional reserve does not only allow banks to lend other people's money, it allows them to create new money. And that money creation is the heart of the modern financial system. This is a topic where there is a lot of confusion. Many economics textbooks still teach a simplified model that is not entirely correct. So we are going to follow the explanation from the Bank of England itself, the institution that knows the mechanism best, because it has been supervising it for 300 years. Let us start with the model that appears in many textbooks. The money multiplier model. It goes like this. The central bank creates a quantity of base money, say, 100 euros. A citizen deposits those 100 euros in a bank. The bank is required to keep, say, 10% in reserve. So it keeps 10 euros and lends 90. The person who receives the 90 euros deposits them in another bank. That bank keeps 9 euros in reserve and lends 81. And so on. Each round of deposit and lending creates a new layer of money. At the end of the process, the original 100 euros have been multiplied to create, theoretically, 1,000 euros in the economy. That is the famous money multiplier, 1 divided by the reserve ratio. This model is elegant. It is easy to understand. And it is not entirely wrong. It captures the basic idea that fractional reserve amplifies money. But it has a fundamental problem. It assumes that banks first receive deposits and then lend. That they need the deposits to make loans. That money multiplies through successive rounds. And according to the Bank of England, that is not how it actually works. The Bank of England's 2014 paper says it with extraordinary clarity. Commercial banks create money, in the form of bank deposits, by making new loans. When a bank makes a loan, it simultaneously creates a deposit in the borrower's bank account, thereby creating new money. Let us read that again. Loans create deposits. Not the other way around. Here is a concrete example. Maria goes to her bank to ask for a mortgage of 200,000 euros to buy a flat. The bank studies her financial situation and approves the loan. What does the bank do? It does not go to its vault to look for 200,000 euros. It does not transfer money from other clients' accounts. It simply types 200,000 euros into Maria's account. That is all. In that instant, 200,000 euros have been created that did not exist before. Maria uses that money to pay the seller of the flat. The seller deposits it in their bank. Now there are 200,000 euros more in the banking system than before the loan. When Maria repays the mortgage, month by month, over 30 years, the money is destroyed. Each installment she pays reduces her debt and, simultaneously, reduces the amount of money in circulation. Loans create money. Repayments destroy it. It is a constant cycle of money creation and destruction. And the total amount of money in an economy depends, to a large extent, on how many loans are active at any given time. If banks can create money simply by approving loans, what stops them from creating infinite amounts? 3 things. First, profitability. Banks are businesses. They charge interest on loans and pay interest on deposits and the funding they receive. If they lend too much into clients who cannot repay, they lose money. Credit risk, the possibility that the borrower will not repay, is the first natural break. Additionally, banks compete with each other for clients. If one bank offers mortgages at 3% and another at 2.5%, clients will go to the second. That competition limits margins and, therefore, the incentive to create loans without control. Second, regulation. Central banks and financial regulators impose capital requirements. A bank cannot lend without limit, it needs to have a minimum amount of its own capital as a buffer against losses. The Basel Accords, a set of international standards, establish how much capital a bank needs based on the risks it takes. If a bank lends too much and its capital ratio falls below the minimum, the regulator intervenes. It can force the bank to stop lending, to raise more capital, or even to close. Third, monetary policy. The central bank controls the interest rate at which commercial banks can obtain funding. If the central bank raises the interest rate, it costs banks more to fund themselves, which makes loans more expensive, which reduces credit demand, which slows money creation. If the central bank lowers the interest rate, the opposite happens: credit becomes cheaper, more people take out loans, and banks create more money. It is a system of accelerator and brake. Commercial banks create the money. The central bank tries to control the speed at which they create it. To understand this system properly, we need to distinguish two types of money. The first is the monetary base, also called high-powered money, or M0. It is the money the central bank creates, the banknotes and coins in circulation, plus the reserves that commercial banks hold deposited at the central bank. In the Eurozone, the monetary base consists of the euro banknotes in your pocket, plus the reserves at the ECB. The second is the broad money supply, also called M2 or M3, depending on the country. It is the total amount of money in the economy, the monetary base plus all bank deposits, current accounts, savings accounts, and other liquid instruments. What proportion does each represent? Here comes the figure that surprises everyone. In the United Kingdom, according to Bank of England data, the monetary base, the money created directly by the central bank, is only around 3% of total money. The other 97% is money created by commercial banks through loans. In the Eurozone, the proportions are similar. The vast majority of money circulating in the economy is not banknotes or coins. It is numbers on computer screens. Numbers that exist because a bank, at some point, approved a loan. When we say that the government prints money, it is an enormous simplification. The government, through the central bank, creates a small fraction of the money. Whoever really prints, or more precisely, types the majority of money is the commercial banks. This system has defenders and critics. The mainstream view, shared by most economists and central banks, says the system works reasonably well. Banks create money when there is demand for credit, which finances investment, housing, and consumption. The central bank controls the process through interest rates and regulation. It is imperfect, but it is the best system we have found. The view of the Austrian school economists like Ludwig von Mises and Friedrich Hayek argues that money creation by banks is the main cause of boom and bust cycles. When banks create too much money, they finance investments that are not sustainable. When credit contracts, those investments fail and recession arrives. The system, they say, has an inherent instability. A third group, movements like Positive Money in the United Kingdom or Volksgeld in Switzerland, goes further. They argue that commercial banks have too much power and that only the state should create money. In 2018, Switzerland held a referendum on this idea, the so-called Sovereign Money Initiative. It was rejected by a wide margin, but the debate reached the public. As always in this series, we do not take sides. All three arguments have merit. What matters is understanding the mechanism. Banks create money. That is a fact, not an opinion. What we do with that fact, whether we celebrate it, tolerate it, or try to change it, is a political decision. If banks create money by approving loans, then the decision of whom to lend to and whom not to is one of the most powerful decisions in the economy. When a bank decides that Maria deserves a mortgage but Pedro does not, it is not only deciding who buys a flat. It is deciding who gets access to newly created money and who does not. Who can invest, start a business, study, and who cannot. Neighborhoods where banks lend little have less investment, fewer businesses, less employment. Neighborhoods where banks lend a lot flourish. And those decisions are not always based solely on objective financial criteria. Throughout history, factors like race, gender, social class, and postcode have influenced who receives credit. In the United States, the practice of denying loans to African American neighborhoods, known as redlining, created inequalities that persist decades later. It was not an evil conspiracy. It was a banking system that, by deciding whom to lend to, was also deciding which communities would grow and which would be left behind. The power to create money is an enormous power. And like all power, the key question is, who supervises it? 5 key ideas from this episode. First, commercial banks create money every time they approve a loan. They do not transfer money from other deposits, they create new money that did not exist before. Second, the money multiplier model taught in many textbooks is a simplification. In reality, loans create deposits, not the other way around. Third, There are three breaks on money creation: the bank's profitability, financial regulation, and the central bank's monetary policy. Fourth, around 97% of money in a modern economy is created by commercial banks. Only about 3% is central bank money, banknotes and coins. Fifth, the system has defenders and critics. The mainstream considers it functional, the Austrian school sees it as a source of instability, movements like positive money want only the state to create money. The debate remains open. Commercial banks create most of the money. But someone has to supervise the banks. Someone has to be the banker to the bankers. The one who lends when nobody else can. The one who raises interest rates when there is too much credit and lowers them when there is too little. That institution is called a central bank. And the first one in history was born from an emergency, a king who desperately needed money to pay for a war. William III of England. 1694. And a Scottish merchant with a bold idea. The Bank of England experiment. That is what comes next.